everyone, and thanks for tuning in to ETF Market Insights. I'm Erika Toth, Director and Head of ETF and Portfolio Consulting at BMO Global Asset Management, and I'll be your host for today. We're going to be joined by my colleagues, Erin, Director of Online ETF Distribution, and Dante, Rossi, Director of Tax and Estate Planning at BMO Wealth Management. And today we're going to be talking about tax planning as we head into the final stretch of 2025. So let's start out with you, Dante. How about you talk to the listeners about what is exactly tax loss harvesting? Maybe walk us through the basics and give us a few examples.
Yeah, sure. Thanks, Erica. And, great to be here. And it's interesting, maybe before I dive into what is tax loss selling, probably reason why we talk about it this time of year, because it's really the way I think about it is it's a year-end tax timing strategy and not necessarily an investment strategy, though recognizing that it can be linked with an investment conversation. And ultimately, what is it? It's the idea of disposing of securities near the end of the year, the calendar year here, with unrealized losses so that investors can potentially reduce the taxes that they would otherwise owe in respect of capital gains that they may have realized previous to the year on the sale of securities earlier. So at the end of the day, the combined total proceeds of the sale between the gains and losses within the year can be used fully for reinvestment purposes without a reduction in the tax burden on those realized gains. So it's essentially just, again, the idea of simply harvesting securities with accrued losses to actually trigger them, realize them for tax purposes to offset gains in the year that were realized. Otherwise, even if no gains are realized in the year, there's still a conversation to think about looking at any accrued loss securities with accrued losses at this time of year, because there may be merit in triggering them as well, even if there's a net capital loss that's realized during the year. So anything in excess of capital gains, or maybe no gains realized at all, there's still an opportunity, because those net capital losses in the year can also actually be carried back to any of the 3 previous tax years to offset gains that may have been realized in the past and recover some of the capital gains taxes that have been paid in those years. So essentially triggering a refund. And to that point, again, if there's even no capital gains that were realized in the past 3 years or in the current year, any net capital loss that is realized can be carried forward into a future year that can be used to offset those future capital gains. So again, it's ultimately a strategy to try and realize some losses to offset taxes paid on gains early in a year.
Thanks, Dante. Any caveats that investors should be aware of if they're considering a tax loss harvesting strategy?
Yeah, that's a great question. And it's really the biggest tax issue to think about when you're executing a tax loss strategy. And it's really to be mindful of what we refer to as superficial loss rules. And again, I think many people may have actually even heard of this to an extent. And it's a rule that I find sometimes people quickly jump to a conclusion that there's this 30-day window, a 30-day time period frame where you're prevented from repurchasing the same security or an identical security, but it's really a 61-day period. And so really, what is the superficial loss rule? It's ultimately a loss denial rule for tax purposes, meaning that capital loss that you're intending to realize and trigger it so that you can offset capital gains can actually be denied if, one, the individual disposes of that security with a loss, and that same or identical security is acquired by that same individual, or actually an affiliated person to that individual, within a 61-day period beginning 30 days before the sale date that gave rise to that loss and ending 30 days after the sale date. And at the end of that 30-day period, after the loss was triggered, if that individual continues to own that security that they repurchased within that 61-day time period, that loss could actually be denied for tax purposes and thereby negating any strategy to try and offset your capital gains taxes. So that's really the biggest tax issue from that perspective to be mindful of.
And one question that comes up a lot in the ETF world is, can I, as an ETF investor, sell an index ETF and then go buy, let's say, another ETF tracking the same index, but that has a different currency exposure? So, for example, I would, let's say, sell the unhedged version of an index and then go and buy the currency hedged version of that index. Is that an allowable transaction for tax loss selling?
Yeah, another good question. And your question is getting it to the heart of these superficial loss rules here, where I mentioned, if an individual disposes of a security and they purchase the same or identical security in that 61-day period, then you could fall into these rules. And so the question becomes, what is the same security or even an identical security? And unfortunately, the tax laws don't provide a clear definition to what is same or identical. And so, in the absence of clear definitions, we do look to CRA interpretation on this matter. They have released certainly a bulletin that talks about what is an identical property with respect to these superficial loss rules. And, they seem to suggest that where the properties are the same in all material respects, that a prospective buyer would not have a difference for one as opposed to the other, then that would tend to lean towards, the two securities being identical for these purposes. Now, on the hedged versus unhedged version, the question is ultimately, is that enough of a material difference, essentially, so that although the underlying index is the same, would that impact around the currency differential be sufficient enough to not trigger these rules? I think that's something that every investor should inevitably consult with their external tax advisor to understand whether that is a material enough difference so that they won't be tripped up by these superficial loss rules. And ultimately, that's a determination that we have to make at that individual level. But those are the issues to be mindful of.
Thanks, Dante. So maybe this is a question for Erin, but markets have had a very fantastic year this year. There may be fewer opportunities this year for tax loss selling than other years, although certain pockets of opportunity do exist. Erin, maybe you could share with us a few of these opportunities that investors should be considering right now.
Yeah, it's definitely a bit of a challenging year for those who are, maybe looking to do some tax loss harvesting in their portfolio, but there are definitely some opportunities. And as Dante was saying around, avoiding that superficial loss rule, ETFs really do make a nice way to keep that exposure on within those 30 days if you are looking to sell an individual stock. So I guess some examples that we found, if we look to the U.S. markets, are in the healthcare sector in particular. So companies like Pfizer, United Health Group, are examples of a couple stocks that are down on a year-to-date basis. And then a couple ETFs that you might look to replace that with if you do want to keep that, healthcare exposure on. ZXLV, our BMO Spider Healthcare Select Sector Index, or even a broad S&P 500 index ETF like ZSP, for example, could give you exposure to those names. Another area, consumer discretionary within U.S. equities, a couple names that were a little beat up this year: Nike, Constellation, even Starbucks, my favorite. And a couple ways you might, keep that exposure on, again, with ETFs would be that's ZXLY, the BMO Spider Consumer Discretionary Select Sector Index ETF, or again, with just a broad BMO S&P 500 index product like ZSP. So some examples in the U.S. market. Here at home in Canada, we can look at companies like BCE or TELUS. And you might look to replace that with either a broad-based Canadian index product like ZCN or BMO S&P Cap Composite Index ETF, or a Canadian dividend ETF like ZDV. So lots of opportunities within the Canadian market along the utilities sector and oil and gas as well. Algonquin Power, Whitecap Resources, Canadian National Railway, all examples of them. But again, you can look to sort of sector-specific ETFs to fill that void in your portfolio if you want to keep some exposure to that sector while you wait at those 30 days.
Thanks for sharing those ideas with us, Erin. Now that we are nearing year-end, it's also crucial for ETF investors to be aware of year-end capital gains distributions. Erin, maybe you could talk to us about why this is so important to be aware of at this time of year. I also want to share with our listeners that you've written an excellent article on year-end capital gains distributions. They're also sometimes referred to as phantom distributions. So Erin, talk to us a little bit about what are phantom distributions and why are they so important at this time of year?
Yeah, thanks for the shout out of my article. Not as spooky as they sound, these phantom distributions. Yeah, so most ETFs pay distributions in cash regularly throughout the year. Some investors take these in cash, some reinvest them, but sometimes instead of a cash distribution, the ETF at the end of the year will reinvest those year-end capital gains back into the fund. And these are what we call phantom distributions because A, you don't see the extra cash in your account, and B, your number of units and the ETF's price don't change. So the distribution is reinvested and then it's immediately the units are consolidated. What's important to note is that these reinvested distributions are taxable, like all distributions within an ETF in a non-registered account. Capital gains, of course, can happen from a number of different reasons within the fund. It could just be regular portfolio rebalancing, could be corporate actions within the underlying stocks in the portfolio. But again, you'll receive all of this information via your T3 slip for the year. Definitely taxable. For investors, why is this important in tax loss selling season? Well, if you're going to do some of this tax loss selling and you end up buying an ETF that's going to be having a large reinvested distribution at the end of the year, you're not really doing yourself any favors. So you might want to consider this as part of your planning as well to investigate whether the ETF is estimated to have a year-end distribution or not. So just something else to consider when you're doing your planning.
And where can investors find this information?
Yeah, so ETF providers will press release it middle of October usually. We did ours last week on the 12th. So you can just Google your ETF provider estimated year-end distributions and it'll pop up. Generally, ETF providers will then release their final distributions mid-December. So if you really want to be sure, you can wait until then, but usually you can use those estimates to gauge the likelihood of a distribution generally.
So any important dates that investors should be aware of this year as it relates either to year-end capital gains distributions or tax loss selling? What are the important dates to remember?
The big one to remember is December 30th. That's the last day for Canadian and U.S. tax loss selling for any type of instrument that settles on a T+1 basis. That's the good thing about tax loss selling is you can do it across ETFs, mutual funds, single stocks, preferred shares, even bonds. But you just want to make sure that that trade is settled before December 31st of the year in which you want that to be realized.
Yeah.
Yeah. So that's the big one.
Yeah. And then for the capital gains, the year-end distributions, I believe the final capital gains distributions for the BMO ETF lineup is going to be announced on December the 19th. So if you go to the BMO ETF's website, you'll see that under news. Any tools, Erin, that would be helpful to investors to help them with year-end tax planning, tools or resources that we get to, that you want to highlight?
So BMO ETFs has a whole range of free tools on our website for ETF users. And within that suite, there's a really great tool called the stock replacement tool, which we see gaining a lot of attraction around this time of year. So if you do have a stock that you're looking to realize a loss on, you can plug that name in to the stock replacement tool, and it'll show you the ETFs in Canada that have the highest exposure to that name. So if you want to keep that exposure in place, you can see what ETFs you might want to plug that hole with in the meantime.
It's one of my favorite tools on our tools section, so thanks for highlighting that. Dante, how about we go back over to you for a moment? We've been mostly talking about year-end tax planning as it relates to individual investors, but are there any special considerations for business owners or corporations that you would want to highlight as we wrap things up?
Yeah, that's a really great question. It's certainly something that's come up a lot with respect to business owners, but more particularly just really anybody or any individual that might be investing through a holding company, through a Canadian private company. And the tax loss selling strategy does become a little bit more nuanced. And that's because of the considerations around what we refer to as a capital dividend account balance, or CDA, commonly termed. And those of you that, those individuals who do have private companies would probably be familiar with that account. And it's really, this account is a notional account. It's a notional tax account balance. You don't see it on a financial statement or any sort of statement of that nature, but it's there as a notional balance that tracks companies that receive tax-free surpluses. And it's such a powerful account because if there's a positive balance in that account, what it does is it provides the ability for that private company to distribute in the form of capital dividends, a tax-free dividend to the individual shareholders who are Canadian residents. So very powerful tool to be able to extract money out of a company on a tax-free basis. Now, what's important to note there is, what makes up the balance of this CDA account? Well, it's generally increased by the non-taxable portion of gains. So we know today gains are 50% taxable. Well, the non-50% portion, the non-taxable portion, goes into this CDA account balance. But similarly, the non-deductible portion of the capital loss, so the other 50% that isn't being offset which isn't being applied against capital gains, will also reduce this balance. But the nuance here is that this balance is really a point-in-time calculation. So where I'm going with this is, if a corporation's got a balance in their CDA account balance and it's positive, they can pay out a tax-free dividend at that point in time. Now, if they're entertaining a tax loss selling strategy within their company, as I mentioned, the non-taxable portion, so the non-deductible portion of the loss, the 50% portion, would actually reduce that capital dividend account balance. And if you're going to reduce that capital dividend account balance, it means less opportunity to be able to pay out a tax-free dividend. So some strategies entail ensuring to find out, what is that capital dividend account balance? Is it positive? If it is, prior to disposing of securities at a loss, it may make sense to try and pay out a tax-free capital dividend, which is a nuanced strategy that requires important legal and tax paperwork to be done. But having that dividend paid out first prior to disposing of the lost securities, so that you're maintaining the ability to pay out that tax-free dividend. So, really the takeaway here is, anytime an investor who's investing through that private company, they really should be engaging with their external tax advisor to understand that balance, how it operates, prior to selling any security at a loss, to ensure that they're not eroding any tax benefits that may be available to them.
Great tip there, Dante. Thank you for highlighting that. So I do want to say thank you to both of you for joining us, for sharing your insights with us on this week's episode. And don't forget, everybody, to join us again next week. Take care, everyone.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.